Most people think investing in stocks is dangerous. But here's the uncomfortable truth. The real danger is not investing. It is not investing right now. If your money is sitting in a regular savings account earning 0.01%, it's quietly shrinking. Inflation is eating it. Prices are rising. And your dollars are losing purchasing power every single year. But because the number in your bank account doesn't go down, it feels safe. That illusion of safety is what keeps millions of Americans stuck. And then there's the other fear. What if I lose money? What if I pick the wrong stock? What if the market crashes right after I start? So people wait. They wait for the perfect time. They wait until they know more. They wait until they have more money. And 10 years pass. Here's what most people don't realize. You don't need to be a stock expert. You don't need thousands of dollars. You don't need to watch the market every day. You just need a simple structure. In this video, I'm going to break down exactly how to invest in stocks as a beginner, step by step, in a way that actually makes sense. No hype, no gambling, no complicated jargon. Just a clear roadmap that can change your financial trajectory if you apply it. By the end of this video, you'll understand what investing really is, how to start, and how to avoid the mistakes that keep most people from ever building wealth. Let's simplify this. Before we talk about accounts or index funds or strategies, we need to fix something first, because most people don't avoid investing due to lack of intelligence. They avoid it because of fear. Let's break that fear down. Fear number 1, I don't want to lose my money. That's completely rational. No one works hard for their paycheck just to gamble it away. But here's the misunderstanding. Investing is not the same as gambling. Gambling is short-term speculation with poor odds. Long-term investing is ownership in productive businesses. When you invest in stocks properly, you are not betting on numbers going up tomorrow. You are buying pieces of companies that produce goods, provide services, hire employees, generate profits, and grow over time. That's not gambling. That's participation. Fear number 2, I need a lot of money to start. This used to be true decades ago. Not anymore. Today, you can start investing with $50, $100, even less. Most major brokerages allow fractional shares, meaning you don't need thousands to buy into strong companies or index funds. The barrier isn't money anymore. It's hesitation. Fear number 3, it's too complicated. And to be fair, the financial world does not make it look simple. There's jargon everywhere. ETFs, expense ratios, asset allocation, diversification, volatility. It feels like you need a finance degree just to open an account. But the truth is this. The basics of investing are simple. The industry just makes it sound complex, because complexity sounds valuable. But wealth building is not built on complexity. It's built on consistency. Fear number 4, I'll need to watch the market every day. No, that's trading. Trading is active. Real investing, is patient. Long-term investors do not stare at charts all day. They build positions. They automate contributions. They let time and compounding do the heavy lifting. Now, here's the most important mindset shift. If you don't invest because you're afraid of losing money, what's the alternative? Keeping it in cash? Over long periods of time, cash loses value to inflation. So the real question isn't, is investing risky? The real question is, which risk do I want? The risk of short-term market fluctuations or the guaranteed erosion of purchasing power over decades? Once you understand that, something changes. You stop seeing investing as a threat. You start seeing it as protection. Because long-term investing isn't about getting rich next month. It's about making sure your future self isn't financially fragile. So before we move forward, understand this. You are not trying to outsmart Wall Street. You are not trying to time the market. You are not trying to become a day trader. You are building ownership. And ownership, over time, build wealth. Now let's simplify what investing in stocks actually means. Let's strip this down to its simplest form. When you buy a stock, you are buying a piece of a company, not a lottery ticket, not a flashy number on a screen, a real business. If you buy a share of a company like Apple, Microsoft, or any publicly traded company, you own a tiny fraction of that business. That means when the company grows, when it earns profits, when it expands, your ownership becomes more valuable. That's the foundation. Stocks represent ownership. Now think about the U.S. economy over the past several decades. Companies innovate. They create products people use every day. They expand globally. They improve efficiency. They increase revenue. Over long periods of time, strong businesses grow. And when businesses grow, their stock value tends to grow with them. That's why the stock market, historically, has trended upward over long periods, not in a straight line, but upward over time. Now here's where people get confused. They mix up trading and investing. Trading is short-term. It's trying to predict what a stock will do next week or next month. It's reacting to headlines, watching charts daily. Try to outguess millions of other participants. Investing is different. Investing is long-term ownership. It's saying, I believe businesses will grow over time, and I want to participate in that growth. You're not focused on what happens tomorrow. You're focused on what happens over 10, 20, 30 years. That time horizon changes everything. Because in the short term, the market is emotional. It reacts to news, to fear, to politics, to economic data. But over the long term, the market reflects productivity and growth. Now let's talk about something powerful. Compounding. Compounding is when your returns start earning returns. Here's a simple example. If you invest $1,000 and it grows by 8% a year, you now have $1,080. The next year, you don't just earn 8% on your original $1,000. You earn 8% on $1,080. And then the next year, on even more. Over decades, that snowball becomes massive. This is why starting early matters more than starting big. Time is more powerful than intensity. And here's something most beginners overlook. You do not have to pick individual stocks to invest. In fact, many beginners shouldn't. You can invest in something called an index fund. An index fund is a basket of many companies bundled together. For example, an S&P 500 index fund gives you exposure to 500 of the largest companies in the United States, all at once. Instead of trying to guess which one company will win, you're investing in the overall growth of the economy. That reduces risk. It increases diversification. It simplifies everything. And historically, broad index funds have outperformed most individual investors over long periods of time. So let's recap this clearly. Investing in stocks means buying ownership in businesses. Long-term investing means holding that ownership while businesses grow. Index funds allow you to own many businesses at once. And compounding turns time into your biggest advantage. When you understand this, investing stops feeling like casino. It starts feeling like strategy. You're not chasing excitement. You're building participation in economic growth. Now that you understand what investing really is, let's talk about how to actually start step by step. Now let's slow this down and make it extremely clear, because this is where most beginners either take action or stay stuck. Step 1. Open a right account. Before you buy a single stock or fund, you need the right container. Think of an investment account like a bucket. The investments go inside the bucket, but the bucket determines how taxes work. If you're investing for retirement and you qualify, a Roth IRA is one of the most powerful tools available in the U.S. Here's why. You invest money that's already been taxed, but your investments grow tax-free. And when you withdraw in retirement, you pay zero taxes on the growth. Over 20 to 30 years, that tax advantage can mean tens of thousands of dollars kept in your pocket instead of sent to the IRS. If you want flexibility, meaning you may need access before retirement, you can open a standard brokerage account. There are no contribution limits, and you can withdraw anytime. You just pay taxes on gains. The important thing is not obsessing over perfection. Open one, fund it, begin. Waiting for the ideal setup delays momentum. Step 2. Choose a simple investment strategy. This is where beginners often overcomplicate things. You do not need to pick individual stocks. You do not need to find the next big company. You do not need to watch financial news daily. Instead, start with index funds. An S&P 500 index fund allows you to invest in 500 of the largest U.S. companies in one single purchase. That means instant diversification. If one company struggles, others may perform well. You're not betting on one winner. You're participating in overall economic growth. You can also consider a total market index fund, which includes even more companies, large, mid-sized, and small. Always look for low expense ratios, fees matter long-term, broad diversification, simple structure, and always avoid hot stock tips, meme stocks, complicated strategies you don't understand, simple wins long-term. Step 3. Invest consistently, not emotionally. Now here's where discipline replaces guessing. Many people think investing is about timing. They wait for a market drop. They wait for better conditions. They wait for headlines to calm down. But markets move unpredictably. Instead, use dollar cost averaging. This simply means investing a fixed amount on a regular schedule. For example, $200 every month, or 15% of every paycheck. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this smooths out volatility and removes the pressure of trying to be right. Consistency beats intelligence in investing. Step 4. Automate the system. This might be the most important step of all. Set up automatic transfers from your paycheck to your investment account, from your bank account to your Roth IRA, automatically purchasing your chosen index fund. Why? Because emotions are strongest during market swings. When markets drop, people panic. When markets rise fast, people get greedy. Automation removes those reactions. You don't decide each month. You don't debate headlines. You don't pause because of fear. The system runs. And over years, that system builds wealth quietly. Step 5. Think long-term from day one. When you invest, commit mentally to a long-time horizon. 5 years minimum. 10 years better. 20 years powerful. The stock market fluctuates in the short term. Some years will be negative. Some years will be incredible. But historically, over long periods, diversified index investing has rewarded patience. If you invest money you'll need in 6 months, you'll feel anxious. If you invest money for long-term growth, short-term volatility becomes noise. That mindset shift is critical. Here's the key takeaway. You don't need brilliance. You need structure. Open the right account. Choose simple, diversified funds. Invest consistently. Automate it. Stay long-term. That's it. Most wealth isn't built by dramatic moves. It's built by small, disciplined actions repeated for decades. Let's zoom out and look at what this approach can actually do for your future. Now, let's step back for a moment, because investing isn't just about opening an account. It's about trajectory. Imagine 2 people, Chris and Anthony. Both are 25 years old. Both earn similar incomes. Both know they should probably invest. Chris waits. He tells himself, I'll start when I make more. I'll start when the market settles. I'll start when I feel more confident. 5 years pass. He finally began at 30. Anthony started at 25, not with a huge amount, just $200 a month into a low-cost index fund. Nothing flashy, nothing exciting, just consistent. Now, let's fast forward 10 years later. Chris has been investing for 5 years. Anthony has been investing for 10 years. Even if they invest the same monthly amount, Anthony is dramatically ahead. Why? Compounding doesn't just grow money. It grows time. The earlier your money starts working, the longer it multiplies. And here's what most people underestimate. The first few years don't look impressive. Your portfolio might grow slowly. It might feel small. It might not look life-changing. But compounding is not linear. It's exponential. The snowball starts small. Then it grows. Then it accelerates. And one day you look at your account and realize your money made more this year than you personally contributed. That's the turning point. That's when you stop feeling like a worker trying to save and start feeling like an owner building wealth. Now, let's make it practical. If you invest $200 per month consistently, earning an average long-term return of around 7 to 10% annually, in 10 years, you're not looking at just $24,000. You're looking at significantly more because of growth. Stretch that to 20 years. Now it becomes powerful. Stretch it to 30 years. Now it becomes transformational. Not because you got lucky. Not because you picked a hot stock. Because you stayed consistent. And here's the deeper strategy most people miss. Increasing your investment rate over time. As your income grows, as you get raises, as debts shrink, you increase your contributions. From $200 to $400. From 10% to 15%. Now compounding accelerates even faster. This is why investing is less about finding the best stock and more about building a long-term system. The real wealth strategy is simple. Start early. Invest consistently. Increase contributions over time. Stay invested. Ignore short-term noise. That's it. It's not dramatic. It's not flashy, but it works. And here's the psychological advantage. When you invest consistently, you reduce financial anxiety because you know your future is being funded. You're not relying only on your job. You're not depending only on raises. You're not hoping Social Security will be enough. You're building your own engine, and that engine runs quietly in the background. That's financial maturity. Now let's protect that engine by talking about the mistakes that can destroy it. Now that you understand how to start, let's make sure you don't sabotage yourself. Because investing success isn't just about what you do. It's about what you avoid. Mistake number 1, panic selling. The market will drop. Not if, when. There will be headlines. There will be fear. There will be days where your portfolio is down 10%, maybe 20%. And in those moments, your emotions will tell you, get out. Protect what's left. But here's what history shows. The biggest gains often follow the biggest drops. When you panic sell, you turn temporary volatility into permanent loss. Long-term investors understand something critical. Volatility is the price of admission. If you want long-term growth, you must tolerate short-term movement. The market rewards patience. It punishes panic. Mistake number 2, chasing hot stocks. You'll see it everywhere. Social media hype. You have to buy this now. This stock is going to explode. It feels exciting, but excitement is not a strategy. Most beginners lose money not because they invested, but because they chased. They buy after a stock has already surged. They follow noise. They react emotionally. Slow, diversified investing may not feel thrilling, but it's sustainable. And sustainable beats sensational. Mistake number 3, trying to time the market. This one traps even smart people. They say, I'll wait for the dip. I'll invest after the next crash. Here's the problem. No one rings a bell at the bottom, and many of the best market days happen right after the worst ones. If you miss just a handful of strong rebound days, your long-term returns shrink dramatically. Time in the market beats timing the market. Consistency wins. Mistake number 4, investing money you'll need soon. If you're planning to use the money in 6 months for rent, for a wedding, for a house down payment, it does not belong in the stock market. Stocks are for long-term growth. Short-term money belongs in safe, liquid accounts. When you invest money you might need soon, every dip feels terrifying. When you invest long-term money, dips feel temporary. Match your time horizon to your strategy. Mistake number 5, checking your portfolio daily. This one sounds harmless, but it changes your psychology. If you check daily, you see every fluctuation. Every red day feels personal. Every drop feels like danger. Long-term investors don't need daily validation. Check monthly, quarterly, even less. Let the system work. Mistake number 6, letting lifestyle grow faster than investments. This is subtle. You start investing. Your income increases. You feel more financially confident. So you upgrade your car, upgrade your apartment, increase spending. There's nothing wrong with enjoying your money, But if lifestyle grows faster than assets, you stay financially fragile. Assets first, lifestyle second. Always. Here's the truth. Investing isn't difficult, but staying consistent when emotions rise, that's the real challenge. If you avoid panic, avoid hype, avoid overthinking, avoid lifestyle inflation, you're already ahead of most people. Because wealth is not destroyed by complexity. It's destroyed by reaction. Now let's talk about the identity shift that makes this process permanent. Let's talk about the identity shift, because this is where it becomes permanent. Up until now, we've talked about mechanics, accounts, index funds, automation, consistency. But none of that sticks unless something deeper changes. Your identity. Because the moment you start investing consistently, you are no longer just someone who earns money. You are someone who owns assets. That shift is quiet but powerful. Savers think differently than investors. A saver asks, how much can I hold on to? An investor asks, how much can this grow? A saver protects income. An investor builds engines. And here's why this matters. If you see yourself as someone trying to invest, you'll stop when it feels uncomfortable. But if you see yourself as an investor, as an owner, your behavior aligns with that identity. Owners don't panic over daily fluctuations. Owners think in decades. Owners understand that businesses go through cycles, but productive assets compound over time. And once you internalize that, every financial decision changes. When you receive a raise, you don't ask, what can I upgrade? You ask, how much of this can strengthen my asset base? When you get a bonus, you don't immediately consume it. You allocate it. When markets drop, you don't see chaos. You see discounted ownership. That's maturity. That's power. And here's the most empowering part. You don't need to be wealthy to think this way. You just need to start. The first time you invest $100, the first time you see dividends hit your account, the first time your portfolio grows without your physical effort, something clicks. You realize income is not your only wealth engine. Ownership is, and ownership scales. This is why investing is not about chasing returns. It's about becoming the type of person who builds long-term wealth quietly. No hype, no showing off, no constant stress. Just structure, consistency, growth. And once that identity locks in, the process becomes automatic. Now let's close this the right way. Let's bring this home. If you've watched this far, here's what you now understand. Investing in stocks is not gambling. It's ownership. You don't need to be an expert. You need structure. You don't need thousands of dollars. You need consistency. And you don't need perfect timing. You need time in the market. The people who build wealth in America are not the loudest. They're not chasing headlines. They're not reacting to every market swing. They open the right accounts. They invest in diversified index funds. They automate contributions. They increase investments as income grows. And they stay patient. That's it. So here's the real question. Are you going to keep waiting until you feel ready? Or are you going to start building ownership now? Because 10 years from today, you will either be grateful you started or wishing you had. If you're serious about building wealth the structured way, not chasing hype, not gambling, not guessing, then subscribe. This channel is for people who want clarity, long-term thinking, and real financial growth. And before you go, I want to hear from you. If you were starting today, what's the first step you'd take? Opening an account, choosing an index fund, setting up automation? Drop it in the comments. Your future self is built by the decisions you make today. I'll see you in the next video.